In this video, I'm going to tell you the UK stocks I'm buying, as well as talking about the Hut Group and Netflix, as well as the comment of the week. And yes, I sound weird because I am unwell, but I'm here recording anyway. So the first item of news this week that I found particularly interesting is actually a takeover bid for the Hut Group. Now, the Hut Group is a business that is in a similar niche to one of my holdings, Boohoo, but not quite. They're both online e-commerce retailers, but they're in different niches. Typically here, the Hut Group is in the niche of more or less beauty and nutrition, whereas Boohoo at the moment is primarily fast fashion, but moving into the beauty industry. So there's some potential overlap and competition in the coming future. Now, the Hut Group has had a pretty shaky history since its recent IPO, where they were IPO'd at a valuation of £5 to £6 billion. However, the CEO and founder, I suppose, or even the chairman, I think he has both roles, which is a position that obviously impacted its eligibility to list on the FTSE. There has been some consequences behind this, as this person, Matt Moulding, has actually responded negatively towards the sentiment of the markets and investors, and this has led to a loss in confidence on the business, and therefore obviously their valuation has been shot down as of late. I think at the moment they're trading at a valuation of just over £2 billion. However, they did see shares rally after this news article that appeared last week. Now, what they've said is that they've had numerous takeover approaches and they've rejected them, as it basically they said that the proposals had been unacceptable and failed to reflect the fair value of the group, which is a promising sign. Although don't forget, obviously the CEO, or the insiders I suppose, do hold quite a large stake in the company, and they're very easily able to do this. Yes, as a matter of fact, the board can obviously reject bid offers and prevent it from going to a shareholder vote, which they very much have done here. However, in this situation, you can also relate this to what's going on with Twitter and Elon Musk. If they decided to fail to bring that to shareholders, despite a valuation that may be seen as fair, then there's going to be a lot of controversy amongst those shareholders. However, in this situation, I think that a lot of people would be in unison that buying this, or if they were to sell for even a premium of the current price, a lot of shareholders would be underwater. And you could say in this situation, well, these shareholders, that's their fault. They shouldn't have bought into an IPO that was overhyped, and that's their loss. And you could be right or wrong with that, right? And I suppose in hindsight, it's very easy to say that. However, in this situation, I think that it's very unlikely that if a bid went through, they would find it fair value, especially as they were recently trading at £5 or so billion. And that's not saying they haven't got any growth left either. They've mentioned here that their revenue has grown up to £2.2 billion, which is up 38.1% for the full year. They said that they expect their guidance to remain unchanged, with revenue expected to grow in the current year by 22 to 25%, which is still a very high amount. However, the downside of this company is that it is not currently profitable, but it is one I am very much interested in if I didn't already hold Boohoo, because they sort of share similar problems and are close enough in niche. Now, I'm very much interested in the nutrition part, and I've heard a lot of people around me going, oh yeah, I'm buying these, I don't know, testosterone pills, or I'm buying these to boost my hormones in my body and it makes me feel a lot better. And that's stuff I find particularly interesting, and I think that is very much a growing market. But again, that is one for your own opinion. We've also seen Netflix shares plunge as their subscriber numbers fall. They mentioned that they've seen their first fall in subscribers in over a decade. They've mentioned that revenue growth has also considered or slowed down considerably. Now, Netflix is one of those that was considered a top tier stock, at least until about 6 months ago. I mean, it was literally part of FANG. You had Facebook, Amazon, Netflix, Google, and someone else, which I've actually forgotten about at the moment. It's lost my mind. It's there, Microsoft as well, I suppose. But anyway, in this situation, Netflix is not proving to be that resilient. Now, in my opinion, before I carry on reading this article, I do think Netflix is a resilient business. They mentioned here that the high number of household sharing accounts and growing competition is a concern, including sluggish economic growth. However, in this situation, they're on about that they're going to obviously cut down and they're going to stop these sharing accounts. And I think realistically, the value that is offered already by their subscription is not something that is going to be cut in a tight economic environment. Why would you still be paying for instance, things like cable TV with, let's say, Sky, for example, when you're paying £60 odd a month, when you can spend, what, £10 a month to have Netflix subscription and access to a bunch of TV shows and films. Yes, the content on there has stagnated. They've not really, in my opinion, really developed their portfolio of entertainment property. But again, they have had some one or two good films, and I suppose these days I don't really use Netflix that much either. But again, there's potential there going forward if they invest more on their content rather than their marketing. But again, that is just my unvalid opinion, I should say. Invalid, not unvalid. COVID, they mention, has clouded the picture significantly, which increased their growth much in 2020, much like some of my holdings, such as Boohoo and even Games Workshop. That has led to believe that most of their slowing growth in 2021 was due to the virus pull forward. Now they believe that there are four main inner factors related at work, which is your sharing accounts, growing competition, and obviously macro factors including the war ongoing in Eastern Europe. Now, Bill Ackman, you may or may not have known about him. I definitely know about him because he is a good investor, although he's one that's very much gone to the media before and almost panicked or pretended to panic so that he could get a better position or sell out or make some money. So he's not one to really be trusted, but he has got a good track record and he is a very knowledgeable individual. I suppose if you're invested underneath him, then you're likely to be protected by whatever antics he gets up to. But again, I'm not recommending that because, again, I believe that anyone can do the research and really invest in their own stocks. However, they've mentioned here, and I think this is quite impressive to be fair, that they've pulled their investment after only 3 months with Netflix, by the way. And that is an estimated loss of $400 million. He mentioned that it's extremely difficult to predict how Netflix would fare over the coming years. And you know what? I think that's also quite a fair mention. I think actually these content library, or I suppose these media companies that are online with all of these TV shows, there's a lot of increasing competition from things like Disney Plus, Amazon Prime, Apple TV, Hulu. Need I go on? But there's HBO Max, etc. A lot of these are competing with each other, and whilst formerly it was a very lucrative market to be in, it's now become a very competitive market, and one that I think might be quite difficult to grow, especially because, yes, whilst they're cheaper at the moment, they need to increase their revenue somehow, so they're going to push up prices to therefore invest in more content. However, in this position, it makes them difficult to therefore grow their customer base or increase customer satisfaction. I actually believe here that companies that have a main revenue stream or income stream outside of this media stake is going to do quite well. So the ones I think will do quite well going forward are certainly Amazon Prime, Apple TV, and Disney Plus. These are businesses that have completely independent business models and that don't need to rely on this whatsoever. Apple TV, for instance, they can throw loads of money into that, but then again, I'm not really a fan of iTunes either. I don't think they really delivered that down the right path at all, but then I'm not really someone that follows Apple too closely. But I certainly think Amazon with their AWS or their Amazon Web Services and the amount of cash flow that they have, even though they're temporarily making losses in their retail segment, can seriously throw some money into that and really make it a very valuable offer to have. And the same with Disney Plus. Disney has quite a lot of exclusive intellectual property, and they can sort of make a lot out of that. And they're releasing quite a few interesting Star Wars shows at the moment. And I'm not really that big of a Star Wars fan, but I recently rewatched some of them, and I thought, you know what? That does look quite interesting indeed. Anyway, I digress. Netflix is set to lose millions more subscribers this year as people start to cut back on discretionary spending with inflation spiraling. This is what I disagree with. I don't think this is the case. If you're going to cut back things, you're not really going to cut back entertainment. You're not going to go, oh yeah, you know what, I really need to save money. Oh well, £14 a month is going to Netflix. Let's just cut that back and then just stare at TV and just watch white noise on the TV screen. Ridiculous. That is not something that's going to get cut back as part of discretionary spending. I believe that's become more of a staple. Unless they're holding multiple subscriptions to different platforms, like I mentioned earlier, that is not something you'd be cutting down that immediately. I think that really is quite ridiculous. Instead, you'd be looking at things going, well, you know what? Actually, I've been buying a lot of unnecessary gadgets, I'll cut that down. Or I've been buying a lot of fancy clothing from premium brands that I don't really need, so I'm going to go a little bit cheaper, for example. Now, they've also mentioned that their way of reviving this and remonetizing the platform is that they're going to launch a discounted subscription with advertisements for the first time. And this is a clever business model, especially for someone like me that uses a certain feature called ad block, which you could probably see. Now, I've cropped it out of the video. But again, that is something that will generate a lot of revenue for them because adverts are very, very lucrative. This would be a great time if I put an advert on this video, but I don't know if I'm that savage. Anyway, the comment of the week Honestly, I don't think you have accepted your mistake in going basically all in on Boohoo. I understand your reasoning and the way that you have dealt with your losses, but I still think that deep down you believe that Boohoo will rally back up above its highs and you will be vindicated. I'm going to hold there. In this situation, I do believe Boohoo will rally above my average share price because I believe the underlying value of the company with its financials and its potential growth over the future will reflect a higher fair value than what I currently have as an average price. Yes, I'm underwater by about 40%, and this isn't about being vindicated. I'm not trying to prove to you whether I'm right or wrong, because quite frankly, for over the last year and a half, I've been wrong, and my shares have been down a significant amount, which I'll talk about later. It's not about vindication. I'm not trying to prove a point here because, again, it's not something I need to prove. I don't need validation from you guys on YouTube. Anyway, it's just not going to happen. Boohoo, at best, is going to be going sideways for at least the next 2 years. I'm not sure how you can predict that, but if that happens, that would be a very good sign for myself, and I will continue accumulating as long as they're delivering on their underlying financials and growing at faster rates than I obviously, or than the market, then I'm happy with that and I will continue to buy. I understand that you like the business, so I don't recommend dumping the stock, but I think you should seriously crystallize some losses, as that is the time where you will fully understand the consequences of your actions. I feel you should sell, say, 50% of your Boohoo position. Build up a decent sized cash position for the next 3 months while you do a deep dive on a stock that you can own, which is a hedge against your Boohoo position, but you still like it. I'm going to disagree with this again. If I believe that this stock is going to go up, and therefore I think it's a good investment, why would I sell half of my stake just to crystallize some losses so that in 3 months' time I could somehow do enough research to find another stock that effectively hedges against Boohoo and is a good investment? Again, as I say, I disagree with that. I don't think that's an effective strategy. I think we all have very limited good ideas, and our best ideas is where our attention should be, and I think Boohoo is one of my best ideas, without saying it's my idea, if that makes sense to you. In that regard, I'm not just going to dump 50% of my position just to crystallize some losses, because I truly believe that they will recover over time, providing the underlying business model does back that result. And again, if it doesn't, then I'll sell. That's fine. But to find another stock in 3 months with, I don't know how much research I can do in 3 months, but I'm not going to find another attractive investment that I think really rivals Boohoo, and then waiting that time because I'd be out of the markets. In that time, Boohoo could recover. Their results are in the next few weeks, or at least their full year financial report, and there could be some positive signs there. And I appreciate the positive comment at the bottom. I appreciate the support there, Mungo Balaki. Thank you very much. I'm going to leave that. But volatility is your friend over a long time frame is very far from the truth, you mentioned, and I disagree with that as well. When we look actually at my portfolio, we can see at the moment I'm down 41.88% over 740, or pretty much 750 days at this point. That is equivalent to £13,085. Now, in total, I've deposited £31,245 and 24 pence. In fact, I think that number is actually £1,000 higher than that. So I think it's actually 32,000. I've improperly put in the data into my spreadsheet. Now, this is a significant drop, and at the moment I'm holding a cash position of 2.8%, or £501.61. The next few days I'll be depositing £750 more, and having just some cash available. Yes, Boohoo is down about 45%, and it is a good value compared to my average price, but I'm just steadily buying some shares. I'm in no rush to really average down at an extreme pace, but I did obviously notice when it dropped down to 60 pence that was the case. Again, I'm in no rush because I do like the business, but I'm also just holding a little bit more cash in case the markets do become a little bit more turmoil, whilst also developing that position and averaging down. Because my average price at the moment is pretty much £1.60 per share, and considering where it was over a year ago at roughly £2.50 per share, I think that is really an impressive movement. And for the long term, I'm very satisfied with the current portfolio size and positions, and I think this will do quite well. But I'm obviously going to be depositing more money in, adding more money, and really trying to see these positions develop over time. Now, I hope you liked this video. Thank you for watching. Have a fantastic day.